The S&P 500 equity risk premium is now at the lowest levels we've seen in 20 years. But what does it mean? With the equity risk premium falling below zero, it means that in theory, less risky treasuries are now paying a higher yield than the S&P 500. So does that mean the market is overdue for a correction? Let's dig a little deeper and find out. Before we do, just a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So what is equity risk premium? The equity risk premium is the additional return investors expect when they invest in stocks instead of safer assets like government bonds. It reflects the reward for taking on the uncertainty and volatility of equity investments. Why is equity risk premium important? Equity risk premium helps investors determine if stocks offer enough potential returns to justify the risks compared to safer investments like bonds. For example, if the equity risk premium is high, it suggests that equities are expected to outperform risk-free assets significantly, which may attract risk-tolerant investors. Equity risk premium helps investors balance risk and return when deciding how much of their portfolio to allocate to stocks versus safer assets like bonds. If we take a look at it another way, this is the S&P 500 earnings yield going back multiple decades, and we can see that the current yield for the S&P 500 is about 3.34%. And if we look at that historically, that's very much towards the lower end of the range that we've seen for the past 50 to 60 years. In conclusion, the equity risk premium is a cornerstone of finance, shaping decisions around investment strategies, valuation, and risk management. So what do you think? Are stocks or bonds a better investment right now for the relative level of risk? Thanks for watching and have a great day.